As Alfecca and Nomi both pointed out, we don't have the money for the infrastructure that we need. And where is it going to come from then? We need some sort of workaround. Alexander Hamilton faced a similar situation in 1791 when they had a $44 million debt from the Revolutionary War. And so Hamilton's solution was to turn the debt into capital for the first bank of the US. So state debt was accepted in partial payment for stock in the bank, paying a 6% dividend. So this bank NIB would pay a 2% dividend, similar model. The bank leveraged this capital into credit, issued as the first US currency. Loans were to be for infrastructure and development based on the fractional reserve model. Hamilton wrote, "It is a well-established fact that banks in good credit can circulate a far greater sum than the actual quantum of their capital in gold and silver." And that is, as Nomi pointed out, that is how banks still create money today. This is a quote from the Bank of England, 2014. "Banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. In fact, they said bank deposits make up 97% of the amount of money currently in circulation." And on the right there, you can see how that works. You start with a deposit of $100. Assuming a 10% reserve requirement, you hold back 10, loan out 90. That 90 goes into another bank, which lends out 90%, et cetera, until you've lent out 10 times what you started with. So the off-budget financing mechanism was modeled by the Reconstruction Finance Corporation during the Great Depression, when the banks were bankrupt, and obviously the government was not in great shape either. So under Jesse Jones, Secretary of Commerce, the government repurposed the Reconstruction Finance Corporation, which had been established by the previous president, to help the banks, and it didn't really work. So it was greatly expanded to fund development. They started with a modest $500 million in capitalization. They issued bonds. It was not actually a bank. Lent or invested over $40 billion over the next 25 years, funded the New Deal, rebuilt the economy, funded World War II, and actually returned a net profit to the government. So it was actually a moneymaker for the government. And they did all that, 40 billion in new loans, without creating price inflation. As you can see on this chart, inflation didn't really take off until till the 1960s, Vietnam War, et cetera. So why was it not inflationary? Sorry, because supply increased with demand. So GDP went up along with the money. Inflation results from too much money chasing too few goods. So if your goods go up at the same rate as the money, you don't get inflation. The Reconstruction Finance Corporation was actually called a workaround. According to James Butkowitz, professor of economics at the University of Delaware, the RFC was an executive agency with the ability to obtain funding through the Treasury outside of the normal legislative process. Thus, the RFC could be used to finance a variety of favored projects and programs without obtaining legislative approval, and actually they actually borrowed from the federal government, but again, even though the debt went up, the GDP went up, so it wasn't a problem. And China has funded its massive infrastructure achievements in the same way or similar way. China built 26,000 miles of high-speed rail in a mere 15 years, along with the world's largest dam and power station. So how did they fund it? The government owns 80% of Chinese banking assets, including 3 massive development banks led by China Development Bank. China Development Bank is not a depository bank, but it's funded with government-backed bonds. The high-speed rail system is self-sustaining, so using the fair revenue model. So the revenue from the ticket sales is reinvested in maintenance and expansion. And again, China's money supply actually increased by 1,800% over 23 years. So that's like a factor of 18 times, and still it wasn't inflationary. You can see at the bottom chart is inflation. Why not? Because GDP went up at the same rate. Supply went up along with demand. So we can do that as well with the HR 4052, the National Infrastructure Bank Bill. This bill will be a bank, unlike the Reconstruction Finance Corporation. Capitalize the first US bank with federal securities paying a 2% dividend, redeemable after 20 years. It will lend 5 trillion or more, as Becca just pointed out, we need more. Over a period of years for infrastructure, specifically for infrastructure and development. And it can curb inflation by actually generating supply, which will rise to meet the increase in the money supply. And a national infrastructure or public banks in general can lend at the lowest possible interest rates. If you compare private banks and public-private partnerships, which has been proposed so far, they all want a hefty profit. So private banks want at least the prime rate, which is the rate at which they lend to their best customers, plus a 3% spread. So that's 12% today. And private investors also want a big profit on top of what they lend. Whereas public banks, using the depository money multiplier model, can charge near the Treasury bond rate or the Fed funds rate plus 2%. So well, it still sounds high, but it's 7% today. And you might ask, well, if local governments are already in debt, how are they going to repay these loans? They can fund the loans with revenue bonds, which is what was done in the Great Depression. So the revenues generated by the infrastructure produced by the loan can be used to repay the loan. For example, in California, we have the situation right now where we have 42 dams that need to be repaired, but because we don't have the money to repair them, they're not producing what they could produce due to safety concerns. So there's a cap on what they're allowed to produce. Repairing the dams, it's been estimated, could generate additional water estimated to be enough to serve 3.6 million people for a year. So that would increase the revenues you would get from the water, and that revenue could go back to repay the loan from the National Infrastructure Bank. So that's all I got. Thank you very much.